All right, let's jump right into this. If you were tracking the data with us, you know our exact target of 24,200? Yeah, it was perfectly hit on Friday. Literally a textbook move. But you know, the market never actually sleeps. What happened underneath the surface right before Friday's closing bell is, well, it's absolutely fascinating. Today, we're decoding the operator's hidden game plan for Monday, July 13th, 2026. We are basically looking at a financial crime scene, and the fingerprints left behind by the big institutional players, they tell a very specific story about exactly where this market is headed next. So here's our game plan for today. We'll start with the institutional clues, then look at a massive option chain plot twist, lay out Nifty's master setup, and finally wrap up with the Bank Nifty and Sensex blueprint. Let's get to it. Starting off with part 1, the institutional clues. Before we figure out where Nifty is going, we really need to figure out who is driving, right? Right now, there is a very clear us versus them dynamic playing out. On one hand, you've got the retailers. They're often driven by emotion, maybe a bit of weekend anxiety, and their bias right now is heavily bearish. In the options market, retail traders have been aggressively selling calls and buying puts, and in stock derivatives, completely negative. But then, you look at the foreign institutional investors, the FIIs. These guys are calculated, they are incredibly well capitalized, and their bias, unapologetically bullish. While retailers were busy selling calls, FIIs actually added 37,000 calls. And in stock derivatives, they are sitting on a massive long position of 47,000 stock futures. This is your classic setup where smart money is taking the exact opposite side of retail sentiment. So basically, retailers are holding their breath over the weekend, actively betting on a fall. Meanwhile, smart money is just quietly positioning for a massive rally. The FIIs are clearly flexing their bullish strength here. Honestly, if you just looked at this data in a vacuum, you'd think Monday is going to be a straight-up rocket ship. But you and I both know the market is never quite that simple, is it? Which brings us to part 2, the option chain plot twist. Okay, so when we dug into the option chain data, we found a massive anomaly just hiding in plain sight, 315,000. Take a second and just let that number sink in. That is the sheer volume of put options accumulated by proprietary traders, the pros, on Friday alone. They literally loaded the boat with puts heading into the weekend. Which, of course, leads us to the single most important question we can ask right now. Why? I mean, if the overall market structure is so positive and FIIs are heavily long on futures and calls, why on earth would the pros hoard this massive mountain of puts? What exactly do they know that the rest of the market is just completely ignoring? Well, here's the crucial piece of the puzzle. It's all about calculated hedging. The pros are hedging against weekend global news, geopolitical risks, you name it. They know the broader data is bullish, sure, but they also know that a single piece of bad news over the weekend could trigger a brutal gap down opening on Monday morning. So, these puts, that's their insurance policy. If the market gaps down, those puts print money and protect their bullish positions. But here is the real secret sauce to the setup. Because that underlying FII data is so incredibly strong, if a gap down does happen, there is a very high probability of a sharp recovery bounce, pulling us right back to that magnetic 24,200 level. They're just going to cash out those puts right at the open and ride the recovery wave all the way up. All right, let's move to part 3, Nifty's master setup. Let's translate all these clues into a solid battle plan. Here is your immediate playbook. We have a strict bearish zone, meaning we only consider the market truly weak if Nifty breaks and actually sustains below 24,150. On the flip side, we have our bullish zone. If Nifty breaks above 24,300, boom, that's your signal that the upside momentum is fully confirmed. Everything floating around between those two numbers, honestly, it's just noise. Let's talk about the downside risk first. That 24,150 to 24,200 zone is effectively the line of control. Why? Because the FIIs are the ones who sold all those puts to the retail buyers in the first place. Think about it. If you're a massively capitalized institution and you just sold a literal mountain of puts, you are going to defend that zone with everything you have. You're definitely not going to let the market easily slide below 24,150, because if it does, you start bleeding money. That support is heavily fortified. So, how exactly should we size our trades based on this? It all comes down to strict rules. If Nifty is just hovering between 24,200 and 24,250, guys, this is a trap. It's a classic no trade zone. Or, at the very least, you should be using super light quantities just to test the waters. The real action only kicks in when key levels break. If we get a strong, undeniable bullish candle pushing through that 24,250 to 24,300 resistance zone, then you can confidently move to medium or full long positions, looking for that 24,400 target. Conversely, if that heavily defended support fails and we somehow drop below 24,150, that's when you flip the script. Shift to medium or full short positions and look to buy puts. You just have to be patient and let the market prove its direction by breaking these boundaries first. Finally, let's wrap things up with part 4, the Bank Nifty and Sensex blueprint. Because Nifty never moves in a vacuum, Bank Nifty's fate is currently tied to one very specific commodity. Step 1, you absolutely have to monitor crude oil. For Bank Nifty to really rally, crude oil needs to stay subdued, ideally staying below that 6,870 mark. When crude drops, banks win. It's that simple. Step 2 is watching Bank Nifty hold its own crucial line in the sand, which is at 58,000 key level. If it holds 58,000 and crude oil behaves, it is primed and ready to fly. And step 3 just ties it all together. We already have positive IT sector results, like those really strong TCS numbers, giving us a nice tailwind. You combine a strong IT sector with a lower crude oil price, you're looking at the perfect recipe for a bullish breakout across the broader market. Now, for Sensex, the math is just incredibly straightforward. The definitive line in the sand is 77,500. It really is that simple. If the market gives you bearish price action and starts dropping below 77,500, that is your explicit cue to increase your short quantities, targeting down to 77,000. But if Sensex pushes above 77,500 with solid bullish momentum, you do the opposite. You increase your long quantities and ride it right on up towards 78,000. For Monday, 77,500 is your ultimate pivot point for Sensex. So there you have it. We've laid out the clues, we've mapped out the exact zones, and we've decoded that massive hedging strategy the pros put in place on Friday. Smart money knows exactly what they're doing. They're fully prepared for the worst while quietly positioning for the best. The institutional chess match is completely set up. The only question left is, are you ready for the opening bell? Keep these key levels on your screen, stay disciplined with your position sizing, and let the market show its hand. Thanks for hanging out with me to decode all this data, and I'll catch you in the next one.